Inflation, core inflation, CPI, what are those things? Why does inflation happen? And what do central banks do to control inflation? What happens to your hard-earned money when there's inflation? And what can you do? In today's video, I'm going to answer all these questions, and by the end of the video, you will have a clear understanding of how inflation works and how you should protect yourself from the potential risk. If you're new to my channel, my name is Charlene. I'm a chartered financial analyst with 10 years experience in finance across Asia and Europe. I make videos on personal finance, money tips, financial market, investment, and career and personal development. Subscribe to my channel now to get one step closer to your financial freedom. Inflation, core inflation, CPI, what are those things? Inflation. Imagine you go to your favorite pizza place and last year your favorite slice cost you $2. But this year when you walk in, you notice that the price has gone up to $2.50. That's inflation. Inflation is like a sneaky price hike that happens to everything over time. It's when the prices of goods and services in the whole economy generously rise. So if your dollar doesn't buy as much as it used to, inflation can be good in small amounts, but if it goes wild, it can erode your purchasing power and make your money worth less. Core inflation. Now let's talk about core inflation. Imagine you love trying new pizza toppings and sometimes you go to fancy ones like truffle oil. But those can be kind of crazy expensive, right? Core inflation strips away those fancy toppings and focuses on basics like cheese and pepperoni. It ignores the extreme price swings in things like gas or food that can happen because of temporary factors. Core inflation helps us see the underlying trend in prices without getting distracted by those wild swings. CPI, Consumer Price Index. The CPI is like a shopping basket that tracks how much it costs to live your life. Imagine you put all your everyday expenses into a basket: rent, groceries, clothes, and so on. The CPI measures how much the total cost of that basket change over time. So if last year it cost you 100 to fill the basket, but this year it cost you 105, that's CPI increase of 5%. It's a way to tell us how much more or less we have to pay for the same stuff we buy regularly. CPI is an index, it's an indicator. Governments around the world use CPI to compare how their economies are doing. It helps them figure out if prices are rising too fast or too slow and whether they need to take action to keep things stable. In a nutshell, inflation is the general rise in prices for stuff you buy. Core inflation focuses on the basics and ignores wild price swings. And CPI is like a shopping cart that keeps track of all the costs of living. It's an indicator that helps us understand how the price of everyday items are changing over time. Why does inflation happen? 1. Higher demand. Imagine there are more people who want to buy stuff than there is stuff available. It's like when everyone wants the video game, newest video game, but there are not enough copies. Because everyone's eager to get it, the price goes up. 2. Higher cost. If it costs more to make things like cars or clothes, companies might charge more for those things. It can happen if the cost of materials like steel or cotton goes up, or if they have to pay their workers more. It's also cost, right? So when their costs go up, they often pass the higher cost to you in the form of higher prices. 3. Too much money printed. When government print too much money, it can also lead to inflation. Think about a classroom where a teacher rewards students with gold stars for good behavior. At the very beginning, gold stars are rare and students treasure them. But this teacher decides to give out tons of gold stars away every day. So now every student has a big pile of them. With so many gold stars floating around, their value decreases. Students start trading more and more stars for simple things like pencils or erasers. Just like that, when there's an excessive amount of money in circulation, each individual unit of currency becomes less valuable, and this can result in prices going up. So to sum it up, inflation happens when 1. There's a higher demand for stuff. 2. When it costs more to make stuff. 3. When there's too much money around. What do central banks do to control inflation? Okay, before we answer, I just wanted to say if so far you found this video helpful, please don't forget to give a like and subscribe for similar content. Okay, let's continue. Banks, like the central bank in the country, have a few tricks to try to control inflation, just like a chef with different recipes. Here's what they do. 1. Interest rate magic. One of the most powerful tools they have is interest rates. Think of it like an aircon in your house. When it's too hot in the house, inflation is too high, they might want to turn up the aircon by raising interest rates. This makes borrowing money more expensive, so people and businesses slow down spending and it cools off the economy. 2. Talking the talk. It sounds funny, but sometimes banks use their words to calm things down. They give speeches and announcements to tell everyone their plans. If people believe they're serious about keeping inflation low, it can help stabilize prices. 3. Money supply. Banks also keep an eye on how much money is floating around. If there's too much cash in the market, they might reduce it by, for example, selling government bonds. Less money means less demand for goods, which can help keep price from rising too quickly. 4. Bank rules. Central banks often set rules for other banks to follow. These rules can influence how much money is available for borrowing. They can influence spending and, in turn, inflation. 5. Exchange rates. Sometimes banks pay attention to the value of the country's money compared to other countries. If their money is getting too strong, it can make imports cheaper and lead to lower prices. They might take steps to balance this out. So, in simple terms, banks use interest rate, words, money supply, rules, and exchange rates to control inflation. They want to keep the economy not too hot, but not too cold as well. What happens to your money when there's inflation? When there's inflation, your money doesn't have the same buying power as they used to. Imagine you have 100, you can buy 10 pieces with it today. But as time goes by, inflation starts to happen and prices of things like pizzas goes up. Now, maybe a year later, those same 10 pieces might cost you 110 instead of 100 because of inflation. So your 100 cannot buy as much as it could before. It's like your money is losing a bit of its superpower because it doesn't stretch as far. If you leave your money just like sitting there not doing anything, it's like you're losing out. That's because your savings don't grow as fast as prices are going up. So if you have plans to buy something big in the future, like a new car, you might find it costs a lot more than you thought because of inflation. In a nutshell, when there's inflation, your money's purchasing power weakens and it can't buy as much as it used to. To combat this, many people look for ways to make their money grow faster than prices are rising, such as buying stocks and real estate. Are they really good ways to manage inflation risks in markets? Most people still believe inflation will remain a big risk in 2024. Do you want to know the top 3 things you can do to protect your money from losing value to inflation? Subscribe to my channel, turn on the notification, and stay tuned. I will explain everything in my next video. In the meantime, inflation is closely tied to interest rates. If you're interested in learning more about the interest rates, please check out my video on all you need to know about interest rate. If you're curious about how inflation and this broader deflation work together, I've also got you covered in another 10 minutes video. You'll find all the links here, and I will see you in my next video.